Hello everyone, and welcome to our yet another discussion on the solution for Activity 6.4 on the accounting rate of return. Of course, in our previous discussion, we have mentioned that the accounting rate of return is the ratio of the average annual profit after tax to the average annual investment. We have looked at the formula, we have looked at the acceptance criteria, where we have appreciated the fact that a project will be accepted under this technique if its calculated accounting rate of return is greater than the company's required or target required rate of return. A number of times you read about the accounting rate of return as the average rate of return, so that would mean the same thing. And again, you will see some of the text referring to the accounting rate of return as the return on capital employed, or the ROCE. All of these, of course, point to the same measure, which is the accounting rate of return. In our previous discussion, we have seen that the accounting rate of return falls under the non-discounted cash flow techniques together with the payback period method. So in this activity, we want to appreciate the computation of the accounting rate of return. And of course, I'll take you straight to our question. And of course, here we are given that we have a company that has a target return on capital employed of 20% for its capital investment, and the company is now considering the following project. So the project is estimated to have a cost of 80 million and estimated to go for a period of 4 years. So the examiner has given us some of the profits, and these profits are before depreciation. We have year 1, we have 20 million, year 2, we have 25 million, year 3, we have 35 million, and year 4, we have the 25 million. We are given some additional information on slide number 14, and they're saying that the capital asset is going to be depreciated at 25% of the cost each year. And then, of course, they are indicating to us that the asset has no residual value. And of course, we are required to assess whether this project should be undertaken by the company. All right. So I'm going to take you to my computation schedule here. Okay. Solution to Activity 6.4, accounting rate of return. Now, of course, the best way to approach this question is through its formula. And of course, we want to appreciate the formula first as our very first step. And we're saying that the accounting rate of return is calculated as the average annual profit after tax as the numerator, with the denominator as the average annual investment. So what we are going to do, we are going to approach this question in a stepwise kind of fashion. And of course, in our step number 1, we are going to calculate the average annual profit after tax. That's going to be our step number 1, okay? And then our step number 2, we are going to calculate the average annual investment. And of course, we shall have a full discussion there on how to determine the annual investment. So straight away to our step number 1, we want to calculate the annual profit after tax. So to calculate the annual profit after tax, of course, you will have to look at the profit figures given in the question. So if I take you back to our question, okay, if I take you back to our question, we are given profits before depreciation. So I'm going to pick up all of these figures and create a table in my computation schedule. Then I begin to treat the cash flows accordingly. So, of course, I'm taking you to my computation schedule. I pick up the figures for profit before depreciation. Now, year 1, we have the 20 million as given in the question. Year 2, we have the 25 million as given in the question. Year 3, we have 35 million as given in the question. And year number 4, we have the 25 million given in the question. So, of course, these are profits before depreciation, meaning that we have to compute the depreciation charge so that we can deduct these depreciation from these profit figures. Now, time and again, I've been asked by students whether taxation is brought into the computation of the accounting rate of return. Now, of course, obviously, in our question here, we don't have any tax information. We don't have the corporation tax rate. Ideally, we would ignore the tax figures. But of course, when you continue to read, if you continue to have in-depth discussion or reading or research on this method, you discover that this method actually has three major limitations. One, it ignores inflation, which is a real factor of the economy. Number two, it ignores taxation, which is a real factor of the economy. And number three, it ignores accrued interest, which is a real factor of the economy. So all in all, we shall not need to treat taxation in our solution here, and therefore the profits before tax ideally will act as the profits after tax. After we have deducted our depreciation, the profits before tax will act as our profits after tax. So that's taxation should not be a worry when you're handling this method. So ideally, to be able to come up with a good computation, I'll need three more columns. I'll need a column, as you can see here. I'll need a column to handle my depreciation charge. Okay. I'll need another column to handle my profits after tax. Okay. So if this is my column A and this is my column B, then the column for profit after tax is going to be A minus B. So I'm going to put figures which are differences between the figures in column A and in column B. However, I do not have the figures for the depreciation charge. Okay, I do not have the figure for the depreciation charge, so I have to work out the annual depreciation charge using the information given in the question. All right, so before I move into my working one, I need to go back to the question and see which factors, which elements am I going to, what are going to be the ingredients of my depreciation calculation. So number one, we have the cost of the asset. That is number one. We have the cost of the asset, which is 80 million. So that's going to be one of the ingredients. Number two, I have the residual value. That's the other ingredient. And then I have the estimated life of this asset. So these three, your guess is as good as mine, can be comfortably used to calculate the straight line annual depreciation charge. So in this sheet, clean sheet that you see right here, I'm going to put my working number one, where I'm going to calculate the depreciation charge on this asset. All right, so we continue by saying that, I just highlight this, we continue by saying that using the straight line method of depreciation, okay, using the straight line depreciation formula, of course this is from our financial accounting, the annual depreciation charge is equal to the initial investment. We add on the residual value and then we divide with the number of years. So I've already highlighted all these in our question here. The annual, the cost of the asset is 80 million. The expected life is 4 years. And the residual value is nil for that matter. So straight away to my workings, I will substitute 80 million where we have the initial investment. I'll substitute the 0 to stand for the residual value, which is nil. And then I'll divide with the 4 years. And of course, the asset is going to use of your calculators. You can try to compute this, and that indeed we come to 20 million per annum as our annual depreciation charge. So this is what I'm going to transfer to my computation schedule under the annual depreciation charge. So it's going to be 20 million all over, and definitely I proceed. I'll put the 20 million for year 1, I'll put the 20 million for year 2, I'll put the 20 million for year 3, and the last 20 million for year number 4. So when you add up the annual depreciation charge, definitely that gives you the 80 million. So we proceed to, of course, I've completed those two columns, and therefore we proceed to our column number 3 for profit after tax to include the differences between profit before depreciation and the annual depreciation charge. So of course for year 1, when you get the 20 million minus the 20 million, definitely that comes to a 0. So I'll put the 0 in the column for profit after tax under year number 1. Next, if I get 25 million minus the 20 million, definitely that is going to give you the 5 million. Okay, you can check with your calculators. That gives you the 5 million, and definitely I'll put 5 million under profit after tax for year number 2. Next, I move to year number 3. I get the 35 million profit before depreciation minus 20 million annual depreciation charge. That will give me a figure of 15 million profit after tax for year number 3. Remember, we mentioned that the profits before tax are going to act as the profit after tax, as of course we have already appreciated the fact that the method is limited in such a way that it ignores taxation, ignores accrued interest, and also ignores inflation, which has of the economy. So finally, I move to year number 4. I subtract 25 million from the 20, and definitely that gives us another 5 million, which I'm going to put in the column for profit after tax. Okay, that's our 5 million there under year number 4. So I'm done with the computations and the differences, and therefore we shall sum up the figures in the column for profit after tax to get the total figure for our profit after tax. So generally, the total of the profit after tax comes to 25 million. So this is my very nice table there, okay, showing how I've arrived at the different figures which we are going to use to calculate the annual profit after tax. So I proceed to the following sheet to calculate my average now. I've got the total, now I need the average. So in our previous discussion, we have already mentioned that the average annual profit after tax, we shall get the total profit after tax, okay, divided by the project duration. So substituting my figures, the profit after tax I've got is 25 million divided by the 4 years, which is the project duration. Definitely, if you check with your calculators, it gives us 6,220,000 shillings. All right, so we have managed to determine the average annual profit after tax. So we proceed to step number 2 to determine the average annual investment. Now, again, from our previous discussion, we have appreciated the formula for determining the average annual investment. And definitely, this is our very nice formula here. We have said that the average annual investment, we get the initial investment, we add on to that the residual value, and divide by a 2 right there. So, what is my initial investment? That is your 80 million. What is my residual value? That is 0. Divided by 2, that definitely gives us the average annual investment. You can try with your calculators and see whether what I'm getting is equivalent to what you have. All right. This gives us 40 millions. This gives us 40 millions. And these are my 2 figures that I'm going to feed into my accounting rate of return formula. All right, so I proceed to step number 3 to determine the accounting rate of return. And of course, from our previous discussion, we've mentioned and appreciated the fact that the accounting rate of return is the average annual profit after tax, which you have got according to our step number 2. 6,250,000. That is step 1, and that is our average annual profit after tax. Next, we divide as the denominator, we divide with the annual investment, average annual investment. So from our step number 2, we got a 40 million. Step number 2, we got a 40 million as our average annual investment. And of course, we need a percentage. We shall multiply everything with 100%. We need a percentage. We shall multiply that fraction with 100%. So check with the calculators. You'll find that you get 15.6%. Okay, you get 15.6%. All right, for purposes of the examination, do not leave these figures hanging. You must give your analysis. You must give an analysis of the figure that you get. So we shall proceed by giving our analysis and interpretation, and we shall say our project will not be undertaken. This is very sad. We are not going to undertake this project. And what's the reason? The project has failed to yield the target return of 20%. Okay? I repeat, the project will not be undertaken because it has failed to yield the target return of 20%. Its calculated accounting rate of return, okay, these two figures here, its calculated accounting rate of return is lower than 20%. So basically, this demonstrates the calculation of the accounting rate of return. And of course, I would request you to try out these two. This is going to be your assignment. I request you to try out activity 6.3. Activity 6.3 handles payback period method. I want you to try out that one. And then also try out activity 6.5, which handles accounting rate of return. Activity 6.5 is of my interest, which is on accounting rate of return, because this one is going to give us a scenario of two mutually exclusive projects. So please try it out and please don't miss out. I'll give you support.